Let me tell you something that might surprise you. If I lost everything tomorrow and had to start over with nothing but the knowledge I've accumulated over 9 decades of investing, I wouldn't buy Berkshire Hathaway stock. I wouldn't hunt for the next Coca-Cola or Apple. I wouldn't spend my days reading annual reports and calculating intrinsic value. I'd do something much simpler, and I'd buy 3 ETFs and let compound interest do the heavy lifting. Now, I know what you're thinking. Warren, you've spent your entire life picking individual stocks. You've built one of the largest companies in the world by finding undervalued businesses and holding them forever. Why would you abandon everything you've preached for decades? And that's exactly the point I want to make today. What works for me, what I've dedicated my life to mastering, isn't what I'd recommend for most people. In fact, it's not what I'm recommending for my own family when I'm gone. I've told my trustee to put 90% of my wife's inheritance into a low-cost S&P 500 index fund and 10% in short-term government bonds, not in Berkshire stock, not in a carefully selected portfolio of blue-chip companies, in an index fund. And if that's good enough for the people I love most in this world, it should tell you something. So today, I'm going to share exactly which 3 ETFs I would buy if I had to rebuild my wealth from scratch in 2026. More importantly, I'm going to explain why these 3 funds can set you up to retire with millions, even if you're starting with very little. And I'm going to show you the mathematics behind compound interest that most people never truly understand until it's too late. But first, let me take you back to a moment that shaped everything I know about investing. It was 1942. I was 11 years old, and I'd saved up $114.75 from delivering newspapers, selling golf balls, and various other odd jobs. That was real money back then. My sister Doris had saved an equivalent amount, and together we bought 3 shares of City Service preferred stock at $38.25 per share. The stock immediately dropped to $27. I watched our investment lose almost 30% of its value, and I was terrified. I held on, and when it recovered to $40, I sold. I was so relieved to have made a small profit that I didn't care about anything else. Then I watched that same stock climb to $200 per share. That lesson cost me about $480 in missed gains, but it taught me something worth millions. Patience pays, staying invested pays, and trying to time the market is a fool's game. That 11-year-old kid eventually grew up and bought his first real investment property at age 14. I purchased a 40-acre farm in Nebraska for $1,200. Not because I knew anything about farming, but because I understood a simple principle. Buy good assets at fair prices and let time do the work. That farm has been in my family for over 80 years now, generating income year after year, completely independent of what the stock market does on any given day. Now, you might be wondering why I'm telling you these old stories. Because the principles haven't changed. The mathematics of compound interest haven't changed. Human nature hasn't changed. What has changed is that today you have access to investment vehicles that didn't exist when I was starting out. Vehicles that make it incredibly simple to build wealth without spending your life studying balance sheets and income statements. I'm talking about ETFs, exchange-traded funds. And if you don't fully understand what these are or why they're so powerful, let me explain it in the simplest terms possible. An ETF is a basket of stocks that trades on an exchange, just like an individual stock. When you buy 1 share of an ETF, you're buying a tiny piece of dozens, hundreds, or even thousands of companies all at once. This gives you instant diversification. You're not betting on one company succeeding. You're betting on the entire economy growing over time. And historically, that's been one of the safest bets you can make. The beauty of ETFs is that they're passively managed. There's no expensive fund manager making decisions, taking fees, and usually underperforming the market. The ETF simply tracks an index, like the S&P 500, and adjusts automatically as companies enter or leave that index. The costs are incredibly low. We're talking about expense ratios of 0.03% in some cases. That means for every $10,000 you invest, you pay $3 per year in fees. Compare that to the typical actively managed mutual fund, which charges 1 to 2% per year and usually underperforms the index anyway. Over 30 or 40 years, that difference in fees alone can cost you hundreds of thousands of dollars, maybe millions. I've said this before and I'll say it again. For the vast majority of investors, the best thing you can do is put your money into a low-cost index fund and forget about it. Now, let me address something head on because I know people will say it. Warren, isn't that hypocritical? You spend all your time picking individual stocks. Why should we do something different? Here's my answer. I've spent 75 years studying businesses. I read 500 pages a day. I understand accounting, corporate governance, competitive advantages, and management quality at a level that comes from decades of focused practice. That's my job. That's what I'm good at. And even with all that expertise, I'm telling you that most people, even most professional investors, cannot beat a simple index fund over the long term. The data proves this conclusively. Over the past 15 years, more than 90% of actively managed large cap funds have underperformed the S&P 500. 90%. These are professionals with MBA degrees from Harvard and Wharton, with teams of analysts, with access to company management, with sophisticated computer models. And they still can't beat the index consistently after fees. So why would you think you can? Why would I think I can, starting from scratch today? The answer is I wouldn't even try. I'd take the simple path, the path that's proven to work, the path that lets you spend your time living your life instead of obsessing over stock charts and quarterly earnings reports. Let me tell you about the 3 ETFs I would buy if I were starting over today. These aren't complicated. There's no secret sauce. But the combination of these 3 funds will give you everything you need to build serious wealth over time. The first ETF is VOO. This is Vanguard's S&P 500 ETF. It tracks the 500 largest companies in America. When you own VOO, you own a piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, yes, my own company, along with 495 other businesses. These are the companies that drive the American economy. The most profitable, most resilient, most innovative enterprises in the world. As of right now, shares of VOO trade around $567. Now, if that seems expensive, don't worry. Most brokerages today allow you to buy fractional shares. You can invest $50 or $500 or whatever amount you have, and you'll own a proportional piece of the fund. Here's what really matters. The expense ratio on VOO is 0.03%, 0.03%. That means if you invest $10,000, you pay exactly $3 per year in fees. I've spent my career looking for good deals, and that is an extraordinary deal. You're getting access to the 500 best companies in America for essentially nothing. Now, why the S&P 500 specifically? Because these companies represent about 80% of the total U.S. stock market value. They're not small speculative businesses. They're established giants that have proven they can generate profits, survive recessions, and adapt to changing times. Some will fail, sure. That's capitalism. But the index automatically removes the losers and adds the winners. You don't have to do anything. And here's the beautiful part. You're not just owning these companies as they are today. You're owning them as they grow and evolve. Think about this. In 1980, the largest company in America was IBM. Today, it's Apple. In 2000, the top 5 companies were General Electric, Exxon, Pfizer, Citigroup, and Walmart. Today, the top 5 are Apple, Microsoft, Google's parent, Alphabet, Amazon, and NVIDIA. The index adapts. You don't have to predict which companies will dominate in 20 years. You just own all of them and let the market sort it out. VOO or any S&P 500 index fund should be the foundation of your portfolio. This is where I'd put the majority of my money if I were starting over. It's boring, it's simple, and it works. Over the past 50 years, the S&P 500 has returned about 10% per year on average, including dividends. Some years it's up 30%, some years it's down 20%. But over long periods, That 10% average holds remarkably steady, and 10% annually is enough to turn modest savings into millions through the power of compound interest. But we'll get to those calculations in a moment. The second ETF I would buy is SCHD. This is the Schwab U.S. Dividend Equity ETF. Now, this one is a bit different from VOO. Instead of owning the 500 largest companies, SCHD focuses on about 100 high-quality companies that pay consistent dividends and have strong fundamentals. What do I mean by dividends? A dividend is when a company shares its profits directly with shareholders. Instead of keeping all the cash, they send you a check, usually every quarter. Companies that pay dividends tend to be mature, stable businesses with strong cash flow. Think Coca-Cola, Procter & Gamble, Johnson & Johnson, Verizon. These are companies that have been around for decades, that generate reliable profits, and that want to reward their shareholders. SCHD currently has a dividend yield of about 3.5 to 4%. That means if you invest $10,000 in SCHD, you'll receive about $400 per year in dividend payments. And that's just at today's prices. As these companies grow their profits and increase their dividends over time, your income grows too. Now, why would you want dividend-paying stocks in your portfolio? Because they provide stability. When the market gets turbulent, when growth stocks are crashing, dividend stocks tend to hold up better. People flock to safety. They want companies with real earnings, real cash, flow real money being returned to shareholders. That's what SCHD gives you. The companies in SCHD aren't selected randomly. They have to meet strict criteria. They need at least 10 consecutive years of dividend payments. They need strong free cash flow. They need reasonable valuations. And they need to have increased their dividends over time. This screening process weeds out the weak companies and leaves you with the strong, stable businesses that can weather any storm. I've always loved dividend-paying stocks. In fact, some of my best investments over the decades have been companies with strong dividend growth. When I bought Coca-Cola back in 1988, I paid about $1 billion. Today, Berkshire receives over $700 million per year in dividends from that investment. The dividend alone is almost as much as our original purchase price, and we still own all the shares, which are now worth about $25 billion. That's the power of dividends compounding over time. Now, here's what makes SCHD particularly interesting if you're building wealth for retirement. Those dividend payments can be reinvested automatically to buy more shares. And as you accumulate more shares, you receive more dividends, which buy more shares, creating a snowball effect. This is especially powerful in tax-advantaged accounts like IRAs or 401 plans, where you don't pay taxes on those dividends until you withdraw the money in retirement. The expense ratio on SCHD is 0.06%, $6 per year for every $10,000 invested. Still incredibly cheap. And in return, you're getting a portfolio of high-quality, dividend-growing companies that can provide both income and stability. I would allocate a meaningful portion of my portfolio to SCHD, especially as I got closer to retirement age. When you're young, you can afford to take more risk and go for pure growth. But as you age, having that steady income stream becomes more valuable. You want to know that even if the market crashes, you're still receiving dividend checks to live on. The third ETF I would buy is QQQ. This is the Invesco QQQ Trust, which tracks the NASDAQ 100. This is where things get more aggressive. QQQ is heavily weighted toward technology and innovation. We're talking about companies like Apple, Microsoft, Amazon, Tesla, NVIDIA, Meta, the businesses that are shaping the future of how we live, work, and communicate. The expense ratio on QQQ is 0.2%, which is higher than VOO or SCHD, but still very reasonable. And what you're getting for that slightly higher fee is exposure to the most innovative, highest growth companies in the world. Now, let me be clear. QQQ is more volatile than the S&P 500. It swings harder in both directions. When tech stocks are booming, QQQ can return 20, 30, even 40% in a single year. But when tech sells off, it can drop just as hard. This isn't for the faint of heart. Here's a sobering example. During the dot-com crash from March of 2000 to October of 2002, QQQ fell about 83%. 83%. If you had invested $100,000 at the peak, it would have dropped to $17,000 at the bottom. Most people couldn't stomach that. They sold at the worst possible time and locked in their losses. But here's what's remarkable. If you had bought QQQ at the absolute peak in March of 2000, right before the crash, and simply held through all the pain, all the fear, all the headlines saying tech was dead, you would have earned about a 14% annualized return from then until today. 14% per year, even starting at the worst possible moment in modern market history. And if you had been smart enough to keep buying during the crash, using dollar cost averaging to accumulate more shares at lower prices, your returns would have been even better, maybe 18 or 19% annually. That's the power of staying invested and not trying to time the market. This is why I love QQQ as part of a portfolio, but only as a part. I wouldn't put everything into it because the volatility can be stomach churning. But as a portion of your holdings, maybe 20 to 30% for a younger investor, it gives you exposure to the companies that are driving the future of the economy. Think about what the world looked like in 2000 versus today. We didn't have smartphones, social media didn't exist, cloud computing was barely a concept, electric vehicles were a fantasy, e-commerce was tiny. Look how much has changed. And the companies in QQQ, they're the ones that made those changes happen. They're the ones that will likely drive the next wave of innovation too. Now, one thing people misunderstand about these high-growth tech companies is why they trade at higher valuations. Let me explain something about return on invested capital, because this is crucial to understanding why paying up for quality can be worth it. Imagine two companies. Company A can invest $1 billion and earn a 10% return. That's $100 million in additional annual profit. Not bad. Company B can invest that same $1 billion and earn a 30% return. That's $300 million in additional annual profit. Now, if both companies can keep reinvesting their profits at these rates, it's only a matter of time before Company B becomes vastly larger and more valuable than Company A, even though they started at the same place. This is why companies like Google, Amazon, and Microsoft deserve premium valuations. They can take their cash and reinvest it at extraordinarily high rates of return. They have network effects, economies of scale, and competitive advantages that allow them to compound their earnings faster than average businesses. Yes, you pay more upfront, but if they deliver those high returns for years or decades, you end up making far more money than if you'd bought cheaper, slower growing companies. That's the bet you're making with QQQ. You're betting that innovation continues, that technology continues to transform industries, and that the best companies will keep finding ways to grow and create value. Based on history, that's a very good bet. So to summarize, here are my 3 ETFs. VOO for broad exposure to the American economy and stability, SCHD for dividend income and quality companies, and QQQ for growth and exposure to innovation. Together, these 3 funds give you diversification across different types of companies, different strategies, and different risk profiles. Now, the question everyone asks is, what percentage should you put in each? And my answer is, it depends on your age, your risk tolerance, and your goals. If you're young, in your 20s or 30s, you can afford to take more risk. Maybe you put 50% in VOO, 20% in SCHD, and 30% in QQQ. That gives you solid diversification with a tilt toward growth. If you're middle-aged, maybe you shift to 60% VOO, 30% SCHD, and 10% QQQ. You're getting more conservative, prioritizing stability and income over aggressive growth. And if you're approaching retirement or already retired, maybe you go 70% VOO, 30% SCHD, and skip QQQ entirely. At that point, you can't afford to lose half your portfolio in a tech crash. You need steady, reliable returns and income you can live on. But these are just guidelines. The beauty of this approach is that you can adjust based on your personal situation. The important thing is that you're invested in high quality assets with low fees, and you're staying invested for the long term. Now, let me show you the mathematics that make this work, because this is where people's eyes glaze over, but it's also where the magic happens. Compound interest is the most powerful force in finance, and most people don't truly appreciate it until they see the numbers. Let's say you're 30 years old. You have $100,000 saved up. Maybe it's from working hard, living below your means, and putting money away consistently. You're going to retire at 65. That gives you 35 years. You commit to adding $10,000 per year to your investments. That's about $833 per month. Not easy for everyone, but achievable if you prioritize it. You invest in these 3 ETFs and earn an average of 9.5% per year. That's slightly below the historical average of the S&P 500, so it's conservative. During retirement, you earn 7% because you shift to a more conservative allocation. You need $100,000 per year to live on in retirement. Run those numbers through a compound interest calculator, and here's what you get. By age 65, you have $6.6 million. $6.6 million, starting from $100,000, adding $10,000 per year over 35 years. That's the power of compound interest. And that $6.6 million invested conservatively at 7% throws off over $460,000 per year. You only need $100,000 to live on. You can spend that, reinvest the rest, and your portfolio keeps growing even in retirement. You'll never run out of money. In fact, when you pass away, you'll leave millions to your heirs. Now, let me show you what happens if you make a common mistake. Let's say instead of buying these low-cost ETFs, you invest with a financial advisor who puts you in actively managed mutual funds. These funds charge 1% to 2% per year in fees. And because they're actively managed, they underperform the index by about 1% annually on average. So instead of earning 9.5%, you're earning 7.5%. And instead of 7% in retirement, you're earning 5%. Run those same numbers again. Suddenly, you don't have enough for retirement. The calculator says you need to save $19,000 per year instead of $10,000, almost double. And instead of having $6.6 million at retirement, you have $4 million. You've lost $2.6 million. And instead of comfortably making it to age 95 with money left over, you run out of money by age 83, all because of higher fees and lower returns. This is why I'm so adamant about low-cost index funds. The difference isn't academic. It's millions of dollars over a lifetime. Now, let me take this one step further. What if you allocate 20% of your portfolio to QQQ and it outperforms by 4% annually compared to the S&P 500? That's aggressive, but it's happened historically. 20% of your portfolio earning an extra 4% equals about 0.8% added to your overall return. So instead of 9.5%, you're earning 10.3%. Run those numbers. You now retire with $8.17 million instead of $6.6 million. That's an extra $1.57 million just from tilting 20% of your portfolio toward growth. Of course, that comes with higher volatility. You'll have years where QQQ drops 30 or 40% and you'll be tempted to sell. But if you can handle the emotional roller coaster, the long-term rewards can be enormous. Now, here's where things get really interesting. There's a strategy I wish I had known about when I was younger, and it's something you can use today to generate additional income from your portfolio. It's called selling covered calls and cash secured puts. This is an option strategy that can add 1, 2, even 3 or 4% per year to your returns. Here's how it works in simple terms. Let's say you own 100 shares of VOO. That's worth about $56,700 at current prices. You can sell someone the right to buy those shares from you at a certain price by a certain date. They pay you a premium for that right. If the stock goes above that price, they buy your shares and you keep the premium. If it doesn't, the option expires worthless and you keep the premium plus your shares. Either way, you make money. This is called a covered call. You're generating income from stocks you already own. And if you do this consistently, month after month, year after year, you can add meaningful returns to your portfolio. Let's say you add 1.5% per year through this strategy. That might not sound like much, but remember those compound interest calculations? Let's go back to our 30-year-old with $100,000, saving $10,000 per year. Instead of 9.5%, they're now earning 11.8% because of the options income. And in retirement, instead of 7%, they earn 9.5%. Run those numbers. They retire with $12.1 million. $12.1 million. They started at $6.6 million with the basic strategy. They've almost doubled their retirement wealth just by adding this one technique. And when they pass away, they leave $127 million to their heirs. Yes, you read that right. Starting from $100,000 and saving $10,000 per year with consistent returns and options income, you end up with over $100 million by the end of your life. That's not a typo. That's mathematics. Now, I'm not saying everyone should run out and start trading options tomorrow. It requires discipline, education, and practice. But the point is that these tools exist. They're available to regular investors. And if used correctly, they can dramatically accelerate your wealth building. Throughout my career, I've always looked for ways to get a little extra edge, not through speculation or gambling, but through intelligent strategies that increase returns while managing risk. Selling covered calls on stocks you already own is exactly that kind of strategy. It's not a free lunch. There's always a trade-off. But for many investors, it's a trade-off worth making. I want to talk about something that doesn't show up in any calculator, but matters just as much as the numbers. Discipline, patience, the ability to do nothing when everyone around you is panicking or celebrating. You see, investing isn't hard because the math is complicated. It's hard because human psychology works against you. When the market is crashing and the news is full of doom, every instinct in your body tells you to sell, to get out, to protect what you have left. And when the market is soaring and everyone is getting rich, every instinct tells you to buy more, to leverage up, to make sure you don't miss out. But those instincts, they're exactly wrong. They're the reason most people fail at investing. The best investors I've known, and I've known quite a few over the decades, they all share one quality. They can sit still. They can watch their portfolio drop 30% and not panic. They can watch their neighbor get rich on some speculative stock and not chase it. They have the temperament to stick to their plan even when it feels impossible. I've said before that investing is simple but not easy. The simple part is buying good businesses at fair prices and holding them. The hard part is watching your net worth swing by hundreds of thousands or millions of dollars and not doing anything stupid. That's the test. Not intelligence, not education, temperament. If you can master that, if you can train yourself to ignore the noise and stick to the plan, you'll do better than 99% of investors. I promise you that. Because most people can't. They trade too much. They panic at the wrong time. They chase performance. They pay too much in fees. And they end up with mediocre returns despite living in the greatest wealth building environment in human history. Let me tell you about my friend and partner, Charlie Munger, who passed away recently. Charlie used to say that the big money is not in the buying and selling, but in the waiting. And he was right. We made most of our fortune at Berkshire not by being brilliant traders, but by buying good businesses and sitting on our hands for decades. We bought Coca-Cola in 1988, and we still own it today. We bought American Express in the 1960s, and we still own it today. That's the strategy. Buy and wait. And that's exactly what I'm recommending you do with these 3 ETFs. Buy them, set up automatic investments every month or every quarter, and then forget about them. Don't check your balance every day. Don't panic when the market drops. Don't get greedy when it soars. Just keep buying consistently and let time do the work. I've lived through more market crashes than I can count. The Kennedy slide in 1962, the bear market of 1973 to 1974 when stocks dropped almost 50%. Black Monday in 1987 when the market fell 22% in a single day. The dot-com crash, the financial crisis of 2008 when the world seemed like it might end, the COVID crash of 2020. And I can tell you with absolute certainty that every single one of those crashes was a buying opportunity, not a reason to sell. The people who panicked and sold during those crashes, they locked in their losses and missed the recovery. The people who stayed invested, or better yet, kept buying through the fear, they made fortunes. It's the same pattern every time. And it will be the same pattern the next time there's a crash, which there will be. I guarantee you that. There will be another recession. There will be another bear market. There will be another moment when everyone is convinced the world is ending and stocks will never recover. And that moment, that's when you need to remember what I'm telling you right now. Stay invested, keep buying, trust the process. Because on the other side of every crash is a new bull market. On the other side of every recession is an expansion. That's how capitalism works. One of the most important lessons I learned early in my career came from my mentor, Benjamin Graham. Ben taught me that in the short run, the stock market is a voting machine, but in the long run, it's a weighing machine. What does that mean? In the short run, prices are driven by emotion, by fear and greed, by momentum and speculation. Stocks go up or down based on what people think, not what they're worth. But in the long run, prices are driven by fundamentals, by earnings, by cash flow, by the actual value of the underlying businesses. And that's why staying invested for the long run is so important, because eventually reality wins. Eventually, good businesses are recognized and rewarded. Eventually, the market weighs the value correctly. When you buy VOO, SCHD, and QQQ, you're buying the best businesses in America. You're betting that over the next 20, 30, 40 years, these companies will continue to grow, to innovate, to generate profits, and to create value for shareholders. And based on hundreds of years of economic history, that's one of the safest bets you can make. Now, I want to address something that I hear all the time, especially from younger people. Warren, the market is too expensive right now. Everything is overvalued. Shouldn't I wait for a crash to buy? And my answer is always the same. Time in the market beats timing the market. Always has, always will. Yes, stocks might be expensive by historical measures, or they might be fairly valued given the strength of corporate earnings and low interest rates. I honestly don't know. Nobody knows. And here's the secret. It doesn't matter, because if you're investing for 30 or 40 years, whether you buy today or wait for a 10% correction is essentially irrelevant. The compound interest over decades will dwarf any short-term timing. Let me give you an example. Let's say the market crashes 20% next year. You'll feel like a genius if you waited. But what if it doesn't crash for 5 years? What if it goes up 30% over the next 5 years and then crashes 20%? Well, you missed out on a 52% gain waiting for a 20% drop. You'd have been better off just buying and holding the whole time. This is why I don't try to time the market, and I've been doing this since 1942. If I can't time it after 80 plus years of experience, what makes you think you can? Just buy consistently, regardless of what the market is doing, and let dollar cost averaging smooth out the ups and downs. Dollar cost averaging simply means you invest a fixed amount at regular intervals. Maybe you put $1,000 into your investment account every month. Sometimes you'll buy when prices are high, sometimes when they're low, but over time you'll pay the average price. And over decades, that average price will be far below where the market ends up. I think about wealth building the same way I think about a farm. You plant seeds, you water them, you wait. Some years there's a drought, some years there's too much rain, some years the harvest is incredible, some years it's disappointing. But over a lifetime of farming, if you keep planting and tending to your land, you'll build wealth. You'll have something to pass on to the next generation. That's what you're doing with these 3 ETFs. You're planting seeds. The dividends you receive, those are like the crops you harvest each season. But you're also reinvesting them, planting more seeds, expanding your farm, And over time, that farm becomes more and more productive, generating more and more income, until eventually you have so much abundance that you can live off the harvest without ever touching the principal. That's financial independence. That's what I want for everyone watching this. Not getting rich quick, not gambling on meme stocks or cryptocurrencies or whatever the hot trend is this week, but building real, lasting, generational wealth through patient, disciplined investing in quality assets. Let me share one final thought with you. I'm 94 years old as I record this. I've been incredibly fortunate in my life. I've made more money than I ever dreamed possible. But money was never the goal. The goal was always freedom. Freedom to spend my time how I want. Freedom to work on projects I find interesting. Freedom to help causes I care about. Freedom to be independent and not beholden to anyone. And here's what I've learned. You don't need to be a billionaire to have that freedom. You don't need to be a millionaire, though it helps. What you need is enough. Enough to cover your expenses, enough to weather emergencies, enough to retire comfortably without worrying about money. And for most people, that number is far lower than they think. If you follow what I've outlined today, if you invest consistently in these 3 ETFs, if you keep your expenses reasonable and live below your means, you will have enough. You'll reach financial independence. You'll be able to retire comfortably, and you'll do it without taking crazy risks, without spending your life glued to CNBC, without the stress of trying to pick the next Amazon or Tesla. You'll do it the boring way, the proven way, the way that actually works. And 30 or 40 years from now, when you're sitting on millions of dollars in retirement savings, you'll look back and be grateful that you started today, that you didn't wait for the perfect moment, that you didn't overthink it, that you just bought those 3 ETFs and stayed invested through all the noise and volatility and fear, because that's all it takes. 3 ETFs, consistent investing, patience, and time. The rest takes care of itself. That's my promise to you based on a lifetime of watching how markets work and how wealth is built. It's not glamorous, it's not exciting, but it works. And sometimes boring is beautiful.